When the market plummets and everyone around you panics, that's precisely when I smile. I'm Warren Buffett, and throughout my investing career spanning over 7 decades, I've made billions by being greedy when others are fearful. Market crashes aren't disasters. They're opportunities dressed in disguise. The greatest sales in the history of business don't happen at Macy's or Amazon. They happen on Wall Street during crashes. In the next 40 minutes, I'll show you exactly why I become enthusiastic when stock prices collapse, and how you can develop the same contrarian mindset that has helped me build Berkshire Hathaway into a $700+ billion empire. This single principle, embracing market downturns rather than fearing them, separates the truly wealthy investors from those who merely survive in the market. Let me be clear, I don't have any special ability to predict market crashes. I can't tell you when the next one will happen. What I can tell you is that they will happen repeatedly throughout your investing lifetime. And while most investors will be paralyzed by fear when they occur, you'll be prepared to act decisively. Take March 2020, when COVID-19 sent markets into free fall. While headlines screamed about the apocalypse and investors dumped stocks at any price, I was looking for bargains. I invested billions in Japanese trading companies when everyone else was running for the exits. I didn't know when the market would recover. I never do. I simply recognized that excellent businesses were suddenly available at excellent prices, or consider 2008, during the financial crisis. When banking stocks collapsed and the financial system appeared to be on the brink of collapse, I invested $5 billion in Goldman Sachs. Many thought I was crazy. The investment eventually netted Berkshire about $3 billion in profit, not because I'm clairvoyant, but because I understand market psychology. The market is a mechanism for transferring wealth from the impatient to the patient. When crashes occur, most investors make emotional decisions driven by fear. They imagine worst-case scenarios and project current conditions indefinitely into the future. This creates extraordinary opportunities for those of us who maintain our composure. My approach isn't complicated. I've spent my life studying businesses, understanding value, and waiting for opportunities when price and value diverge significantly. Market crashes create these divergences on a massive scale. This is when fortunes are made, not by timing the market, but by recognizing value when others can't see past their fear. Let me show you exactly how I've developed this contrarian mindset and how you can apply it to your own investing journey. When I see storm clouds gathering on the economic horizon, I don't run for cover. I build a fortress of cash. This isn't about fear. It's about preparation and opportunity. Throughout my career at Berkshire Hathaway, I've consistently maintained substantial cash reserves, often to the frustration of analysts and even some shareholders who want every dollar working in the market. Let me explain my liquidity strategy clearly. I maintain substantial cash reserves, typically between $100 $150 billion in recent years, not because I'm pessimistic, but because I'm patient. Cash isn't just safety, it's stored potential. When markets collapse, cash transforms from a drag on returns to the most valuable asset in your arsenal. Before the 2008 financial crisis, I had positioned Berkshire with significant cash reserves. While others scrambled for liquidity during the crash, I deployed capital strategically, investing $5 billion in Goldman Sachs with favorable terms no ordinary investor could secure. I didn't predict the exact timing of the crisis, but I was prepared for it. My approach is straightforward. As valuations stretch and economic indicators flash warning signs, I gradually increase cash positions. I don't try to time the exact market peak. That's a fool's game. Instead, I create the conditions where I can act decisively when opportunities emerge. Remember this: during normal markets, cash feels like a burden. During crashes, it becomes your greatest advantage. The psychological benefit is equally important. With adequate reserves, you'll make rational decisions while others panic. My cash strategy follows three principles. First, I maintain enough to cover all operational needs and existing commitments. Second, I keep additional reserves for unexpected opportunities. Third, I scale these reserves based on market valuations. More cash when markets appear overvalued, less when bargains abound. In 2022, as inflation surged and markets tumbled, many questioned my cash position. But by early 2023, we'd deployed significant capital into Japanese trading companies and Occidental Petroleum at attractive prices. The patience paid off. Don't misunderstand. I'm not suggesting you sit in cash waiting for crashes. I'm advocating for strategic liquidity that allows you to capitalize on market dislocations. The goal isn't to predict recessions, but to position yourself to benefit from them. Most investors focus exclusively on returns. I focus equally on risk management. Cash is your financial oxygen tank. You don't think about it until you're underwater and need to breathe. Build your cash fortress gradually as market excesses grow, and you'll sleep well during market storms while positioning yourself to emerge stronger afterward. My quality filter is the heart of what sets my investment approach apart from most traders. I've developed specific criteria that allow me to identify businesses that can withstand economic storms, particularly recessions. When everyone else is panicking, I'm usually buying, but only businesses that pass my strict quality standards. Let me share the exact criteria I use to identify recession-proof businesses. First, I look for companies with durable competitive advantages, what I call economic moats. These are businesses with something special that competitors can't easily replicate. Take Coca-Cola, which I first purchased in 1988. Their brand power is so strong that consumers will pay a premium for their product over generic alternatives. During the 2008 financial crisis, while many companies faltered, Coca-Cola's strong moat helped maintain stable performance. Second, I insist on businesses with high returns on equity without excessive debt. When a company can generate strong returns using minimal capital, it creates significant shareholder value over time. American Express exemplifies this principle. They don't need massive capital investments to grow their business. During recessions, companies with low debt levels don't face the crushing interest payments that force many over-leveraged businesses into bankruptcy. Third, I look for consistent operating histories with predictable earnings. I avoid businesses I can't reasonably forecast 5 or 10 years out. That's why I've largely avoided technology companies until recently. Their competitive landscape changes too rapidly. Compare that to See's Candies, which I acquired in 1972. Their business model has remained remarkably consistent for decades, allowing them to weather multiple recessions with minimal disruption. Fourth, I demand management with integrity and talent. During my acquisition of Geco, I was impressed by how Tony Nicely ran the business with remarkable efficiency and honesty. In recessions, honest management becomes even more critical. They won't hide problems or take excessive risks to maintain the appearance of growth. Finally, I require simple, understandable businesses. If I can't explain how a company makes money in a simple paragraph, I won't invest. This principle saved me from numerous pitfalls. including the dot-com bubble and the 2008 mortgage crisis, while Wall Street chased complex financial instruments they didn't understand. I stuck with businesses whose operations I could clearly comprehend. These criteria aren't just theoretical. They've been battle-tested through numerous market cycles. During the 1973-1974 market crash, the 1987 Black Monday, the 2000 tech bubble, and the 2008 financial crisis, these principles guided my investment decisions and preserved capital when others were losing everything. During market panics, I found my greatest opportunities. When fear paralyzes Wall Street, I become a bargain hunter with a simple playbook. Let me show you exactly how I evaluate companies when everyone else is running for the exits. First, I focus on intrinsic value, not market price. In 2008, when the financial crisis sent markets plummeting, I didn't fixate on daily fluctuations. Instead, I calculated what businesses were actually worth based on their future cash-generating ability. American Express dropped nearly 70% during that crisis, but I knew their competitive moat remained intact. Their business model hadn't fundamentally changed. The market was pricing American Express as if its future was doomed, but my analysis showed otherwise. Second, I use what I call my margin of safety principle. I never pay full price, even for great companies. I demand a substantial discount, typically 30% below my intrinsic value calculation. This buffer protects me when my analysis isn't perfect. During the 2008 crisis, I invested $5 billion in Goldman Sachs, not because I thought the company was worth exactly what I paid, but because I believed it was worth significantly more, giving me that crucial safety margin. Third, I evaluate management integrity ruthlessly during panic. When everyone's desperate, true character emerges. I watch how executives behave when nobody's looking. Do they buy back shares personally? Are they transparent about challenges? During market crashes, I've spoken directly with CEOs like Brian Moynihan at Bank of America before investing billions. I needed to ensure they wouldn't squander capital when the pressure intensified. Fourth, I examine balance sheet strength with extreme scrutiny. In panic markets, companies with heavy debt loads often become forced sellers of valuable assets. I avoid businesses that might need to raise capital at exactly the wrong time. During the 2000 tech crash, many internet companies collapsed under debt, while Coca-Cola, with its fortress-like balance sheet, weathered the storm. Finally, I look for simple, understandable businesses with predictable economics. When panic strikes, complexity becomes a liability. I need to forecast cash flows with reasonable certainty. That's why I invested heavily in reliable businesses like GEICO and Burlington Northern Santa Fe Railroad during market downturns. Remember this: market panics don't change my valuation methods. They simply create more opportunities to apply them. The bargain hunter's advantage isn't superior intelligence, it's superior temperament when others lose their heads. By 2007, I was watching the financial system with growing concern. While everyone celebrated the housing boom, I saw the rot beneath. I began systematically building my cash reserves at Berkshire Hathaway, not out of fear, but preparation. When you see storm clouds, you don't just stand there getting wet. You prepare. I increased Berkshire's cash position to nearly $44 billion by early 2008. My partners Charlie Munger and I weren't trying to time the market. We simply couldn't find investments meeting our criteria. The prices made no sense relative to the underlying value. Remember, price is what you pay, value is what you get, and the gap between them had become dangerously wide. My cash hoarding strategy isn't complicated. It's patience incarnate. I'm perfectly comfortable sitting on mountains of cash for years if necessary. Most traders can't stand the psychological pressure of being uninvested. They feel they must always be doing something. This compulsion is precisely what destroys returns. When the 2008 crisis hit, I deployed capital while others froze in panic. I invested $5 billion in Goldman Sachs in September 2008, securing preferred shares with a 10% dividend yield plus warrants. I put another $3 billion into General Electric under similar terms. These weren't wild speculations. They were calculated moves from a position of liquidity strength. The mathematics is simple. Cash itself doesn't compound much, but the optionality it provides during market dislocations is immensely valuable. I've never made money by panicking, whether out of markets or into them. Cash gives you the luxury of rational decision-making when others are forced into irrational actions. I don't try to predict exactly when markets will crash. I simply prepare for the inevitable moments when Mr. Market offers extraordinary opportunities. Most investors focus on avoiding paper losses. I focus on having the financial and psychological capacity to capitalize on genuine bargains. This approach requires tremendous discipline. During the years I built cash reserves, financial commentators criticized me mercilessly. They called me outdated, overly cautious, past my prime. The pressure to deploy capital is enormous when markets keep rising, but I've learned that you don't get extra points for activity, only for being right. My cash strategy isn't about timing, it's about preparation meeting opportunity. When the financial world was burning in 2008, I had the resources and clarity to act decisively. That's the true value of strategic cash reserves. Not what they earn sitting idle, but what they allow you to acquire when true value emerges from market chaos. When everyone was running for the exits during the 2008 financial crisis, I was making my shopping list. While fear gripped Wall Street, I committed $5 billion to Goldman Sachs and another $3 billion to General Electric. Not because I could predict the market bottom. I can't time markets and never claimed to. I invested because quality businesses were suddenly available at reasonable prices. I've always maintained that price is what you pay, but value is what you get. During recessions, this distinction becomes crystal clear. In late 2008, I wrote in the New York Times that I was buying American stocks. Many thought I'd lost my mind. The financial system was collapsing, housing prices were plummeting, and unemployment was skyrocketing. But that's precisely when the greatest opportunities emerge. My approach during recessions is straightforward. I look for companies with strong fundamentals, minimal debt, and competitive advantages, what I call economic moats. These businesses can weather economic storms and emerge stronger on the other side. During the 2008-2009 period, I increased my positions in American Express, Wells Fargo, and Coca-Cola, companies I understood with durable competitive advantages. I don't buy stocks because they're cheap. I buy quality businesses at reasonable prices. There's a profound difference. During market panics, investors often throw out the good with the bad. That's when I step in. My Goldman Sachs investment came with preferred shares paying a 10% dividend plus warrants, terms you only get during times of distress. Remember, recessions are temporary, but great businesses endure. When you see quality companies trading at 50 or to 60% of their intrinsic value, that's when you should be most aggressive. But this requires preparation, both financial and psychological. You must have cash available and the temperament to act when others are paralyzed by fear. I've lived through many recessions, 1973, 1974, 1987, 2000, 2002, 2008, 2009. Each time the same pattern emerges. Panic selling creates extraordinary opportunities for those with patience and discipline. During the 2008 crisis, I wasn't buying because I thought stocks would rebound quickly. I was buying because the long-term economics of quality businesses remained intact while their prices had been slashed. My recession shopping strategy isn't complicated. It's simply the application of my core principles during times when emotions override logic. Fear is the investor's worst enemy. Greed is the second worst. I aim to be fearful when others are greedy, and greedy when others are fearful. This isn't just a catchy phrase. It's the essence of successful investing through economic cycles. Let me tell you about a contrarian sector rotation strategy I implemented during 2009-2010, right from my desk at Berkshire Hathaway headquarters. While most investors were still licking their wounds from the financial crisis, I was methodically repositioning our portfolio for the recovery, but not in the sectors everyone expected. I've always believed that the time to buy is when there's blood in the streets, even if some of that blood is your own. In late 2009, financial stocks were still deeply depressed. Everyone was convinced the banking system would take a decade to recover. That's precisely when I began increasing our position in Wells Fargo and adding to our American Express holdings. But my sector rotation wasn't just about buying financials. I simultaneously reduced our exposure to consumer staples that had held up relatively well during the crisis. When everyone flees to safety, those safe investments often become overpriced. I look for value, not comfort. The key to my contrarian rotation strategy is patience. I didn't deploy all our capital at once. I built positions gradually throughout 2009 and 2010, which allowed me to average in at attractive prices. Remember, you don't have to swing at every pitch. Wait for the fat one. What most traders miss about sector rotation is the importance of understanding business fundamentals rather than just technical patterns. I wasn't rotating into financials because of chart formations. I was doing it because I understood their intrinsic value was substantially higher than their market prices. Another crucial element was ignoring the financial media's constant noise. CNBC and Bloomberg were filled with experts predicting another leg down for banks. Had I listened to them, we would have missed tremendous opportunities. The market rewards those who think independently. My sector rotation also involved a significant position in railroads, culminating in our acquisition of Burlington Northern Santa Fe. While technology was getting all the attention, I recognized that America's physical infrastructure would be essential to economic recovery. The results speak for themselves. By 2011, our contrarian bets on financials and railroads had significantly outperformed the broader market. But remember, I wasn't trying to time the market perfectly. I was simply allocating capital to undervalued sectors with strong long-term prospects. What you should take away from this is simple. True contrarian sector rotation isn't about being different for its own sake. It's about having the analytical framework to identify genuine value discrepancies across sectors and then having the emotional discipline to act when others won't. That's how you achieve outsized returns over time. Fear is the most expensive emotion in investing. I've seen brilliant minds crumble when markets plunge, selling at the worst possible moment. That's why I've developed a systematic approach to managing fear throughout my career at Berkshire Hathaway. When others panic, I profit. Let me share my psychological framework for handling market fear. First, I deliberately cultivate emotional detachment from price movements. The market is there to serve me, not to instruct me. When the 2008 financial crisis hit and Bank of America shares plummeted 90%. Most investors were paralyzed with terror. I wasn't celebrating the suffering, but I recognized the opportunity and invested $5 billion when everyone else was running for the exits. My second principle is information asymmetry. I spend 5 to 6 hours daily reading annual reports, industry publications, newspapers. This creates what I call my circle of competence, areas where I genuinely understand the business fundamentals. During market crashes, this knowledge gives me conviction while others are drowning in uncertainty. When I invested in Apple in 2016, many thought I'd abandoned my principles. They were wrong. I'd spent years studying the company's ecosystem and consumer loyalty patterns. Third, I use financial redundancy as psychological insurance. Berkshire maintains a massive cash position, often 100 to 150 billion. Critics call it inefficient, but this financial fortress gives me the psychological freedom to act aggressively during downturns. In March 2020, when markets collapsed from COVID-19, I didn't worry about personal financial survival. Instead, I evaluated opportunities with a clear mind. Fourth, I deliberately avoid minute-by-minute market updates. I don't have a computer terminal on my desk in Omaha. This isn't technophobia. It's strategic. Information filtering. Constant price updates trigger the amygdala, the brain's fear center. By checking prices less frequently, I make decisions based on business fundamentals, not emotional reactions. Finally, I use a decision journal to combat hindsight bias. After making significant investments, I write down my reasoning, expected outcomes, and potential risks. This prevents me from rewriting history when things go wrong and helps me identify patterns in my thinking. The market will test your psychological fortitude repeatedly. In 1987, when stocks dropped 22% in a single day, I didn't panic. In 1999, when tech stocks soared and Berkshire lagged, I didn't abandon my principles. In 2022, when inflation surged, I increased my oil company investments while others feared recession. Master your psychology, and you've mastered half the investment battle. Cash is not just an asset. It's a call option with no expiration date. I've always viewed liquidity as the ultimate weapon in my investing arsenal, especially before market storms. When others panic, I pounce. It's that simple. In 1973, when the market crashed, I was sitting on a mountain of cash. Not because I predicted the crash, I've never been a market timer, but because I couldn't find anything worth buying at reasonable prices beforehand. My discipline saved me, then allowed me to feast during the downturn. I operate by a simple principle. Be fearful when others are greedy, and greedy when others are fearful. But you can only be greedy if you have the ammunition, cash, or to deploy when opportunities arise. Without liquidity, you're just a spectator watching the parade of bargains march by. During the 2008 financial crisis, I invested $5 billion in Goldman Sachs when fear paralyzed the market. I put another $3 billion in General Electric. Why could I do this while others couldn't? Because I maintained liquidity. I kept my powder dry while others were fully invested in the bubble. Let me be clear about my liquidity philosophy. I don't hold cash because I'm trying to time the market. I hold cash when I can't find investments that meet my criteria. The cash builds up naturally as a residual of my investment process, not as a market call. I've never let macroeconomic predictions influence my investment decisions. I can't predict interest rates, I can't predict inflation rates, and I can't predict market crashes, but I can prepare for them by maintaining liquidity. My partner, Charlie Munger, and I have always believed that a significant cash reserve gives us not just safety, but optionality. It's like having a loaded gun in a room full of opportunities. You can choose your target carefully and strike when the moment is right. Remember this: the worst position to be in during a crisis is being forced to sell assets at distressed prices. The best position is having the capacity to buy those same assets from the distressed sellers. Liquidity determines which side of that transaction you'll be on. I've always said that risk comes from not knowing what you're doing. But even if you know what you're doing, without adequate liquidity, you can't execute your strategy when it matters most. That's why I maintain cash reserves that others might consider excessive. The market doesn't reward those who predict storms correctly. It rewards those who are prepared when storms arrive, regardless of when or how they develop. Cash is your umbrella. Don't leave home without it. When a recession approaches, I don't run for the hills. I prepare my shopping list. Over decades, I've refined a specific watch list of industries and companies that become particularly attractive during economic downturns. Let me share exactly what I look for. First, I target consumer staples. During the 2008 financial crisis, I increased my position in Coca-Cola while others panicked. People still drink Coke in recessions. It's a small luxury they can afford. I look for companies with pricing power, strong brand recognition, and consistent demand regardless of economic conditions. Procter & Gamble, Johnson & Johnson, and Walmart have historically been on my recession watch list. Insurance companies become particularly interesting to me during downturns. Most investors don't understand this sector, creating mispricing opportunities. When I acquired GEICO, I recognized that good insurance companies maintain underwriting discipline while generating float that can be invested. During recessions, premium valuations often compress, creating entry points for patient capital. Banking is another sector I scrutinize carefully. Not all banks, mind you. Only those with conservative loan practices, strong deposit bases, and disciplined management. During the 2008 crisis, I invested $5 billion in Goldman Sachs and $5 billion in Bank of America when others feared the entire financial system would collapse. I knew the government wouldn't let the banking system fail, and these institutions had the strength to survive. I also pay close attention to utilities during recessions. They provide essential services, generate predictable cash flows, and often offer attractive dividend yields when interest rates decline during economic contractions. I found that regulated utilities with strong balance sheets become particularly undervalued when market fear is highest. The key to my recession watch list isn't just identifying industries, it's identifying the strongest companies within those industries. I look for businesses with 1. Low debt-to-equity ratios. 2. High returns on equity. 3. Consistent free cash flow generation. 4. Durable competitive advantages. 5. Management that allocates capital intelligently. What I don't chase are cyclical companies without competitive moats, regardless of how cheap they appear. During the 2001 recession, many investors rushed into technology stocks thinking they were bargains after the initial crash. I stayed away because I couldn't predict their cash flows with reasonable certainty. Remember, my goal during recessions isn't to catch falling knives, but to acquire wonderful businesses at fair prices rather than fair businesses at wonderful prices. The watch list I've developed over decades helps me remain rational when others succumb to fear. Now, let me tell you about what I call the anti-Buffett approach, the common mistakes that destroy portfolios before recessions hit. I've watched countless investors make these errors cycle after cycle, and they're precisely the opposite of what I do at Berkshire Hathaway. First, chasing yield at the expense of quality. I've seen this destroy more portfolios than almost anything else. When the economy appears strong, investors reach for higher yields through junk bonds or speculative dividend stocks. I never compromise on business quality to gain an extra percentage point of yield. During the 2008 crisis, I watched companies with weak balance sheets slash their dividends while our holdings in Coca-Cola and American Express maintained their payments despite severe stress. Second mistake, excessive leverage. I've maintained a conservative balance sheet at Berkshire for decades, which is why we had $108 billion in cash during the 2020 market crash. This isn't just caution, it's opportunity preparation. While over-leveraged investors were forced to sell at the bottom, I deployed capital into beaten-down quality stocks. Remember, you never know who's swimming naked until the tide goes out. Third, ignoring deteriorating fundamentals. Before recessions, I become increasingly vigilant about balance sheet quality. I scrutinize inventory buildups, accounts receivable growth outpacing sales, and declining cash conversion cycles. These warning signs appeared before both the 2000 tech bubble and 2008 financial crisis. When I see these red flags, I don't hesitate to sell, regardless of recent performance. Fourth, I never attempt to time market tops. Instead, I gradually increase cash positions when valuations become stretched. During the late 1990s tech bubble, I was criticized for underperforming the S&P 500. I simply couldn't find businesses trading at sensible valuations. This patience proved invaluable when the market collapsed. Finally, the cardinal sin, abandoning your investment principles under pressure. I've watched brilliant investors compromise their discipline during both bull market euphoria and bear market panic. My investment philosophy hasn't fundamentally changed since I bought my first stock at age 11. I've refined it, but never abandoned it. Not during the 1973-74 bear market when Berkshire lost 50% of its value. Not during the 2000 tech bubble when we looked hopelessly outdated, and not during the 2008 financial crisis. These 5 mistakes represent the antithesis of my approach. Avoid them, and you'll find yourself positioned to capitalize when others panic. Now, let me give you a practical blueprint for implementing my recession strategy in today's market environment. I've navigated through numerous downturns since the 1960s, and the principles remain remarkably consistent despite changing economic landscapes. First, build your recession preparation well before you need it. I keep substantial cash reserves at Berkshire Hathaway, sometimes $100 billion or more, not because I'm predicting disaster, but because I want dry powder when opportunities arise. You should maintain at least 20-30% cash in your portfolio as we enter uncertain economic periods. This isn't timing the market, it's respecting it. Second, create your personal bear market shopping list today. I maintain a list of wonderful businesses I'd love to own at the right price. During the 2008 financial crisis, I invested $5 billion in Goldman Sachs because I had already identified it as a strong business with temporary problems. Your list should contain 10 to 15 companies you understand thoroughly, businesses with durable competitive advantages, low debt, and strong cash flows. Third, calculate your margin of safety for each company on your list. I never buy based on macroeconomic forecasts. Instead, I determine the intrinsic value of businesses I understand and wait for Mr. Market to offer them at a significant discount. For quality companies, I look for at least a 25% discount to intrinsic value during recessions. Fourth, act decisively when others are paralyzed by fear. During the COVID crash of 2020, I purchased stakes in Japanese trading companies while others were panicking. Remember, widespread fear is your ally as an investor. The time to buy is when there's blood in the streets, even if some of it is your own. Fifth, prepare psychologically. Most investors fail not because of poor analysis, but because emotion overwhelms reason during market extremes. I train myself to be fearful when others are greedy, and greedy when others are fearful. This isn't just a catchy phrase, it's the foundation of my investment philosophy. Finally, remember that recessions are temporary, but great businesses endure. I've held Coca-Cola since 1988 through multiple recessions because its fundamental business strength transcends economic cycles. Implement this blueprint methodically. Don't rush. The patient, disciplined investor who prepares thoroughly before recessions hit will find them to be periods of extraordinary opportunity rather than times of financial distress. That's how I've built my fortune over decades, not by predicting recessions, but by being thoroughly prepared when they inevitably arrive.